Hi, my name's Josh Mahony, Chief Market Analyst at Scope Markets. This coming week brings plenty from a political standpoint, with the French elections leading into the week's trade, and also the UK elections taking place at the back end of the week. We've also got a whole host of economic data across the board, most notably the US jobs report on Friday, which should bring an increased focus as we move towards the back end of the week on the US economic outlook, fresh off the back of that disappointing core durable goods number on Thursday. Now, first and foremost, we're going to get into an overview, and this shows you the sort of big ticket items according to Trade and Economics that we should be watching out for. First and foremost, we'll be kicking things off on Monday with the Caixin manufacturing PMI out of China, and consumer confidence out of Japan. Then we continue to see inflation data coming out of Europe. This time it's Germany leading into the wider figure later in the week. We've got on Tuesday the RBA meeting minutes, the inflation figure out of the eurozone on Tuesday morning. Powell speaking on Tuesday. The JOLTS job openings essentially kicks off the focus on the jobs market, where we're also going to be seeing the likes of the ADP non-farm payrolls figure, the unemployment claims number, and then on Friday we'll see the jobs report, which comes alongside the Canadian unemployment rate and wider jobs report. We've got, of course, the FOMC minutes on Wednesday as well to keep us on our toes. And all of this is brought into play with a weekend election from the French on the Sunday. And then on Thursday, we've got the UK general election. So plenty for traders to consider, certainly, and plenty to give us some volatility within the markets. Now, in terms of the first topic we wanted to talk about, that is the eurozone. Of course, on Sunday we see probably the first round of the French election. This won't necessarily see Macron lose his seat, but there's a good chance that he loses much of his power, because essentially it's looking like it's between two parties, and his party's neither. So you do have the possibility of a run-in with just two parties in a week's time, so on the 7th. And it's essentially the far right and the far left that have sort of joined up into groupings. So significant volatility, significant concerns and uncertainty, because people don't necessarily know what's going to come, what the outlook from markets might do in terms of borrowing costs. You remember it didn't take long for Liz Truss to come in with her supposed pro-growth policies for markets to essentially hike up the borrowing costs, and they booted her out pretty quickly. So what's going to happen in terms of French borrowing costs? How will markets react to Sunday's result from a sort of CAC perspective, from the euro perspective? It's something we'll get into. Elsewhere, of course, we've got this inflation report coming out on Tuesday. And by and large, I think in a month's time, we're probably going to see inflation moving towards the upside. But this time around, the bar is just about low enough for us to be able to beat it. And certainly the early signs point towards a relatively low number. You can see expectations on that headline number, 0.1%. Markets are expecting a 0.2% decline on the headline number. But it's that core reading which is likely to really garner the interest of the bulls, with a move down from 2.9 to 2.5, signaling a high likeliness that we do see the ECB cut rates again in the near future. So if we see it as is expected, 2.4, 2.5, that would be the kind of thing that would embolden people to think that the ECB are going to be able to act soon enough. We have, as you look towards the bottom end here with the focus on the German economy, we have been seeing particular weakness in terms of German PMIs, in terms of the IFO survey, the GfK survey, factory orders and industrial production, as you see at the bottom, both waning. So really, there's a significant concern around the German economy and the Eurozone as a whole. And as long as inflation is heading back down towards target, you have justification to be bullish equity markets and potentially bearish for the euro. And in particular, if we see concerns around the likes of the French economic picture, borrowing costs, that also could hit the likes of the CAC and the euro. So here's a view of how we've seen a big spike in terms of borrowing costs in France relative to Germany. So the French and German 10-year yields in a ratio. That's the orange line. Then you can see the DAX by the CAC. So, the relative performance of the 10-year yield versus the relative performance of the indices. And you can see here significant outperformance in terms of the DAX. And so what's more likely to happen, I think, is that we see significant uncertainty and concerns off the back of the Sunday election result. If the polls are to be believed, that's likely to keep the CAC depressed. But if we see this decline, this welcome decline in terms of the inflation reading from the eurozone, then you're pointing towards a possibility of optimism. And that optimism is probably best expressed through the DAX and not the CAC. And as you can see here, if we see the 10-year yield moving up, in particular in France, you're likely to see outperformance for the DAX. In terms of voting habits for that French election, here's the breakdown recently in terms of the polls from Bloomberg. You can see, in actual fact, the far-right National Rally Group gaining traction. You can see the New Popular Front, which are the left-wing grouping, essentially flatlining. We're not necessarily seeing Macron managing to gain much ground as things stand. In terms of the markets to watch out for, we'll look out here for the CAC first and foremost in terms of the European area to trade. Let me just get this on the full screen. What we can see here is a significant pullback taking shape here. This sharp decline, this rally that always looked like it was likely to fade. Subsequently, we've seen a breakdown below. If you're looking at this on an intraday basis with a view that this is a retracement, then you're saying, okay, how much of this are we going to retrace? We've come into the 61.8. You're probably looking at that as a decent retracement considering the major concerns. And then we see it rolling over with the creation of a new lower low, with the break below 76.19 giving way to selling pressure. And that has been dominating as we're closing out the week. So depending on how the election goes, there's a strong chance that we are going to see further downside coming into play. You need to keep an eye out for that 10-year yield. If we see it spiking, then you're likely to see weakness, in particular around the CAC. But bear in mind, like I said, if we're looking for that eurozone inflation reading, if it comes in low, you're probably going to see greater upside for some of those more stable indices, such as the DAX. In terms of let me just bring up the next area we're talking about. In terms of the UK, we of course have an election, but it's a little bit more of a predictable one closer to home. Quite frankly, we've also got a host of other things. Most notably, I'd say probably the construction PMI on Thursday. We've got the final services PMI on Wednesday. We've got some housing data on Monday and Friday. But by and large, people will generally be focused on the UK election on Thursday. The polls have been very consistent in pointing towards a Labour victory. You can see that the shift of late has actually seen Reform gaining ground in particular. Now, Reform originally took a chunk out of the Conservative vote, splitting that vote and essentially making it near enough impossible for them to be able to overtake Labour. That splitting of the vote has done them no favors. But what we've seen recently is that we've actually seen Reform gaining ground off of Labour as well. So that's probably going to be one of the big stories, really, is the potential overtaking of Reform over the Conservatives. But in terms of how markets might take it, well, look, in terms of the outlook for the UK political picture in the past, in terms of the Labour Party, it's been a view that they're going to hike up borrowing, hike up taxes, and hike up spending. They're in a position where they are not going to be incentivized into rampantly increasing debt. And that is certainly going to be the big ticket item here. As long as we keep debt sustainable, then we're all good. Unfortunately, the focus recently has been more about cuts in terms of taxes rather than pro-growth strategies per se. But if you look at what happened with Liz Truss, we can see exactly what happens when you come out explicitly saying that you're pro-growth and you want to be expansionist in nature, especially when you've got such significant levels of debt in the UK. So I would say that a resounding victory for Labour, which is what is forecast, could be seen as a positive. It gives political stability within the UK, and in particular, the fact that Keir Starmer is essentially viewed as a very centrist form of Labour leader should mean that people aren't too spooked by such a shift. So looking at the pound against the Japanese yen, this is the 1 hour time frame, and we can see that essentially we have just been going up and up and up. And so whilst I think it's likely that we're going to see a relatively orderly win for the Labour Party, or certainly that's how the polls have it, if it does play out like that, I think it would be perceived as a relative good news story for the pound. And that political stability should help lift sterling yen once again. The trend is very clearly your friend on this one until we see an FX intervention from the BOJ, which is the one big risk. And that's why stop losses are absolutely key for this pair, with the break below 203.071, providing us a potential rolling over. But for the time being, this is a market that continues to move towards the upside. And if we see a Labour victory on Thursday and majority, I think you're likely going to see the pound continuing on this trajectory. And finally, I wanted to bring up the US with the fact that we've got, of course, on Friday, the jobs report coming out with a forecasted sharp decline in that payrolls number. So we could be in for a bit of a rude awakening, or maybe it's setting a very low bar for us to be able to easily beat. That will be a key one. Unemployment expected to stay as it is. Average hourly earnings expected to drop down from 4.1 to 3.6. So if you're just looking at that jobs report, you're talking about weaker economy, lower average hourly earnings. Those kind of things would be the indication that the Federal Reserve will have to move soon. And we have been seeing weakness across a number of different economic metrics. It's generally been the payrolls that has helped prop things up. And you can see elsewhere, if we're looking in terms of jobless claims, they have been elevated recently, and we're expecting to see more of the same. The ADP employment change expected to move sharply lower. The JOLTS job openings expected to continue its move lower, a break below the 8 million mark. So plenty here to sink our teeth into in terms of potential concern for the US economy. And certainly if we see that payrolls figure dropping sharply lower, it's the kind of thing that could really start to bring the bulls back into play in a meaningful manner. Now, in terms of the breakdown of those jobs, it has been very notable that generally when we see this strong move towards the upside in terms of payrolls, a lot of that has been driven by part-time employment rather than full-time employment, which if you're looking at full-time employment, that's largely been flatlining over the past year, arguably declining in some areas. And it's been the likes of the part-time area that really has been climbing over recent years. And so, the breakdown of the two, if we see a sharp decline in terms of payrolls, is that coming due to full-time employment moves, part-time employment moves? That's going to be interesting. But certainly this highlights the fact that despite the fact that the jobs report has generally been the backbone of people saying, okay, the US economy is doing really well at the moment, a lot of that can be explained away by people taking on two jobs. Now, another way of looking at it is the Citigroup or Citibank Economic Surprise Index, which essentially sort of looks at all of the different economic data coming out of the economy, and is it surprising towards the upside? It's surprising towards the downside. Well, generally, it has been relatively negative. You can see this decline. Now, we're seeing some weakness in terms of the US 10-year yield as well, but not to the same extent that we're seeing in terms of that economic surprise index. So this does highlight the pullback that we're seeing at the moment, highlights the weakness that we're seeing across a number of these different economic metrics. We're expecting it once again this week with the fact that we're looking towards the ADP number is potentially coming in weak. We're looking at the likes of the payrolls number is coming in weak. But are those levels too low and they're set to be outperformed? That's certainly the key question going forward. But as you can see here, we're seeing this pullback in terms of the 10-year yield. And in part, that's because of the weakness in terms of those economic data points. So are we going to see weakness in terms of the US dollar? Well, actually, the US dollar has been doing relatively well thus far. You can see that if I put that 10-year yield on, that decline that we're seeing in terms of the 10-year yield has not necessarily moved in lockstep with the US dollar, because we've seen this divergence between the 10-year and the US dollar. This, in part, I would believe, is down to the fact that, as I've pointed out on a number of occasions, it looks likely that we're going to see a resurgence in terms of inflation in the coming months. And so you could say, well, there's cause for us to feel concerned about the economy. There's cause to be optimistic about the possibility of a September rate cut. And therefore, we're seeing weakness in terms of the 10-year yield. US dollar, it's almost like it's sort of preparing for the worst and preparing for a potential rolling over in terms of economic, in terms of the markets, and a potential rebound in terms of inflation. So which one is correct on this example? Well, look, if markets are looking for weakness in terms of the economic data, then you're looking at the possibility of a weaker US dollar, as we see the possible sort of dovish outlook coming into play from the likes of the FOMC. Now, if we're looking from a shorter perspective, you can see very clearly that we've got this clear-cut trend. I mean, this is the hourly time frame. So this intraday chart shows you this higher highs, higher lows. Some of them are deep retracements, some of the shallow retracements. We're now tightening somewhat. But as long as this pattern remains in play, then the bulls are still in charge. But once we see a break back below your price swing low to 105,708, that points towards the possibility of this market starting to roll over. So if the economic data comes in particularly weak and you start looking towards a higher probability of an interest rate cut in a few months' time, then you're looking at the possibility of this US dollar strength starting to unwind. And there has been plenty of strength. You can see 2024 has been a bullish one for the US dollar, outperforming most of the major currencies around the world. So is that justified? Well, if we see the economic data continue to sour, and if inflation starts to move towards the downside as a result, then you could start to see the dollar rolling over. At the moment, the intraday chart has not shown that. So we're just waiting for that to come to fruition before we can look at things in a different manner. For the time being, the bullish trend does still remain in play for the US dollar.